True measure of a portfolio is not in its gross value, it's actually in the net. So my foundation has always been to buy capital growth properties and also cash flow. Your job can easily be let go. Hi guys, my name is Jai, and today I'm going to be sharing a video on my personal journey to property investing and also achieving financial freedom. I'm going to be sharing with you the hard truths and also what it takes to be financially free. And there are three things that I want to share in this video. The first thing is sharing with you my personal journey. I believe it's important to document this along the way, what I'm doing, and also share with you how I got to where I am. And I wish I did this when I was younger, and I wish that when I was younger that someone else had done this as well. So that way they can share their blueprint on how they got to their wealth creation at every single level. So I will show you how I got to where I am today and what I plan on going into the future. The second thing that I will take you guys through is also my approach to property investing. And thirdly, how I plan to achieve my financial goals. So first of all, let's go through my personal journey. I've always wanted to become a millionaire. I don't know why. When I was a young kid, I always wanted to be successful. I looked up to people who had money, and I think it's because when I was born and I came to Australia, my parents, they're first generation immigrants, and we never came from money. And the people that are around me that I went to school with all seemed to be wealthier than our family. And I just thought, why were we different? And I saw my parents work a very, very hard life. They worked really, really hard in Taiwan. And when they came to Australia, they had very little money. Their grandparents gave them enough deposit to go buy a house, but they could barely make the mortgage repayments. And from there on, they worked extremely hard, and I saw them grind and grind and grind. One of the biggest things that cause relationship failures is money. So I often saw that my parents were fighting about money and also financial things as well. So I never really wanted to be in that position. So as I grew up, I always thought it's very important to be financially free and also have ability to be able to have additional income. And for me, that was my goal. All right. And I was always taught from a young age that we should be buying a property, right? My parents never taught me that we should be buying a property for investment reasons. I was always taught we should be putting our money into a property instead of going to buy cars or buy other things. So that's what I aim to do, all right, in the very beginning. I worked multiple jobs, started working when I was 14 years old. Today, I have my own business, JD Capital, which is a mortgage broking company. We help people get loans, and we also help people achieve their financial goals through property investing. But it didn't start this way, right? So I studied a Bachelor of Commerce degree, majored in marketing and finance, and I worked for one of the biggest telco companies in Australia. And as I was working through Optus, which was the company that I was working at, I worked there for 10 years. It was my first job out of university, and I'd worked there in the graduate program, and I had a 2-year stint where I did a range of different roles in sales and marketing. And I was exposed to a lot of commercial acumen and also exposed to a lot of budgets and also a lot of financials. And that made me want to invest because I could see that the monies that the businesses were generating, large profits, large revenues, and I could also see that the potential to earn more is also very possible. So that really pushed me to think a lot bigger. And as I was working at Optus, I was a very driven, ambitious kid. And so I've always wanted to work really, really hard. Every year I would sit down with my manager to understand what can I do to try and get a pay rise and also to get promoted. I worked there for 10 years, which is really unheard of today for a lot of people who are coming out of university. A lot of people tend to job hop every 1 or 2 years. I think it was 2019 or 2020 when I officially handed in my resignation, because during that time I had built up a property portfolio of about 3 to 4 mil, and we're talking about gross value, right? But I used that income that I had to build my wealth into property investing. And the reason that I wanted to build my wealth was because I knew that saving my way to wealth would not get me ahead. I remember very clearly my first year's income was about $50,000. After taxes, after expenses, I was barely able to save about $20,000. And so I knew it was very difficult for me to save my way to wealth. Got my deposit up for my first property, and that was my leg into the property market. And I could see a lot of the people who were wealthy had some sort of property or business. And so I knew that this was the pathway that I had to go down in order for me to build my wealth. Bought multiple properties as I was working at Optus, and eventually I hit a capacity limit because I couldn't borrow anymore. And at the time, my broker said the only way for you to borrow more money is to either earn more income or start a business. Business, as we know, your income can be exponentially higher because if you work harder, you tend to be able to earn more income and also have the ability to leverage as well through business. I have to be very honest here. The reason that my portfolio, or our portfolio with my wife, joint portfolio, I must be very transparent. 13 million is a combined portfolio and it's a gross value, right? If I'm very honest with numbers, we are sitting at around 60%, 65% LVR. And I think the true measure of a portfolio is not in its gross value, it's actually in the net equity, right? Because if you had to sell those properties today, what would they be worth? And it's important to have a gross portfolio first because that's what develops your asset base. But you also need to make sure that you've got net equity being generated and also income being generated to sustain the portfolio. So right now, the number one goal that we've been building in the past 12, 13 years has been to build the asset base because it's the asset base that compounds over time. And the larger the asset base, the larger the growth. And so what we wanted to do was build a large enough asset base that compounds faster and faster and faster. And so that's been the number one goal. We've been building and building and building by aggressively acquiring multiple properties, and sometimes in some cases multiple properties in a single year, but it hasn't always been like that. The first couple of years were very slow. 2013 was when I bought my first investment property. It was a 1-bedroom unit that was $428,000. Second property was about 2 to 3 years later because I needed to get the equity from the property to recycle that into the second property. Usually the first property you're going to need a lot of savings. The second and third property and beyond, you can leverage the equity using the earlier properties. Now, leveraging equity just basically means using the growth of the property to recycle into the next property. That's the key. The trick to building a large enough portfolio is by using equity from existing properties. And that basically just means borrowing from the bank on the growth that you've had. Now, let's say, for example, you purchased a property at $400,000 and it went up to $600,000. You've got a $200,000 equity position there. Right, but the banks will only typically lend you up to 80% of the growth because they want to hold on to 20% as security. So the key is, as an investor, if you're starting out and you want to get ahead as well, you really need to focus on strong capital growth or strong capital appreciation in the short term. Long term is really important, but short term is actually more important because for you to get into that second property, to get that larger asset base, you really do need to focus on getting an asset that's going to give you strong capital appreciation. That's what I learned from my many years of investing. Some properties have performed exceptionally well. Some properties have done nothing. And going back to all of those purchases and learnings, what I've learned is that the ones that did not move were the ones that were not able to give me the equity to get into the subsequent property. The success that I've had has been built off buying at the right time at the right market as well. That's really important because if you buy in a market that's stagnant and it's not growing, it's really going to slow you down. That's been my story. My story has been really focused on property investing because I knew that saving my way to wealth was going to be very difficult. I also really wanted to get ahead financially and have the ability to retire my parents, retire my wife, build something for us, and also not rely on our incomes. Because if anything had perspective in the last couple of years through COVID, and also not in my time, but 2008 we did see the GFC, the global financial crisis. Unemployment went up quite a lot. COVID, also lots of unemployment, right? So that gave me a lot of perspective. Your job can easily be let go, right? If a company goes under, if there's an economic downturn, it can really put a lot of pressure on your employment. And if you're highly leveraged at that time, it can really be scary in terms of financial burden and impact. So I really wanted to aggressively invest so I could build financial security and not rely on my 9-to-5 job, right? And also financial freedom is going to mean a lot of different things for a lot of people. For me, the financial freedom is it gives you the freedom to do what you want on your terms. For me, it's not about quitting work. I still work extremely hard and I love work at the moment. right? For me, it's actually creating impact, helping people, but also balancing lifestyle as well, right? It's hard to achieve the lifestyle in the beginning because you do really need to grind for you to build up the ability to have that lifestyle later on. But I understand it's a sacrifice, and I'm willing to sacrifice in the beginning. And so during the first 10 years of investing, I had put in a lot of effort to make sure that I can get ahead financially. And that includes taking second jobs. It even includes working, way above the standard 8 hours, getting promotions, working as hard as I can to increase my income, have the ability to be able to buy property, and also do a lot of extracurricular research and networking and understanding the property market. I've read so many books, podcasts, met a lot of other property investors, and also other people in the industry to be able to learn this. And that applies to anything that you want to learn in the world as well, right? If you want to learn, you want to get ahead with something specific, you've got to be an expert and master at that. And I encourage you, if you want to get into property investing, it is an opportunity available to anyone in Australia. The tax rules, the negative gearing benefits, depreciation, ability to invest, this does not discriminate. I'm also not special at all. Came from a family that didn't have money, and today I'm documenting this because I'm sharing with you guys what actually has been possible for me, and also how I'm doing it and what I've done in the past, and also how I'm also helping other people do it as well, right? Because these are real things that are happening, and these are real things and legal things that you can do to get ahead financially in Australia. That's what I wanted to share in this video, being super honest with what it takes to get ahead financially in property investing. So that's been my story. The second thing that I wanted to share with you guys is how the framework of property investing that I approach, right? There's a lot of different strategies, and there's a lot of different people talking about how to get rich quick and how to build wealth through property investing, subdivisions, developments, house and land packages. There's a lot of things out there. I understand it can be extremely confusing, right? I'm going to give you the fundamentals, and I'm going to give you what has worked for me and what I will be doing in future to help my family and myself be financially free. I could stop work now and be financially free if I wanted to, but I don't want to, because I want to keep building, test my limits, test my boundaries, and also inspire other people as well. Right? So my foundation has always been to buy capital growth properties and also cash flow. Right? I always thought you had to pick one or the other. And the reality is you can find properties in markets that give you both, right? You want cash flow and you want capital growth. The reason is because capital growth gives you the asset appreciation, right? Which is ultimately what's going to get you out of work. The second thing is cash flow. Cash flow is income coming in, right? We have repayments that we need to make on the properties, right? Because you're borrowing at a high LVR, usually when you have little deposit. So you've got repayments and you've also got outgoings and expenses on the property, right? So cash flow is very important, especially when your income's not high. And I'm going to assume that most people, when they start out, their income isn't that strong. So you do need cash flow. Cash flow is what helps you sustain the property repayments. In today's current market, as of right now, as we're recording, we are talking about interest rate level of around 5%, 6%. So I understand it is a little bit different to when I started investing. When I started investing, positive cash flow properties were possible. It is still possible today, but it is a little bit harder. But it doesn't mean that you can't make wealth in a negatively geared property. It's certainly possible. So if you can find a property that is renting at around 4% yield to 5% gross yield, and the interest rate is around 5 or 6%, it's going to be almost neutral. Right? It's going to cost you a little bit of money out of pocket, right? But if the property is, say, for example, a 2% yield and the interest rate is a 6%, you're at a 4% negative margin there, right? So that's going to cost you a significant amount of money out of pocket. Those are the types of properties that will drain a lot of cash flow and be hard to hold. Right? And if we look into the future of building a portfolio basically just means multiple assets within your asset base. And the reason why we talk about building a portfolio is because it's easier to scale, right? So if we put some numbers into perspective, a lot of people want to be financially free. Now, let's say it costs you about $100,000 in expenses a year to be able to give you a very, very good lifestyle, right? So $100,000 of passive income. Now, if we work the numbers backwards, to achieve a $100,000 income from property, and let's assume you can get a 5% rental yield, we need $2 million worth of net assets fully paid off. And if you're buying property of around $600,000, you need around 3 to 4 properties fully paid off. So for you to hit that goal, you need to buy around 4 properties and have it fully paid off by the time you retire. That's why we call it building a portfolio of properties, right? It's also easier to scale into multiple 600K properties over time rather than buy a $2 million property and have it fully paid off, right? Because that cash flow drain is going to be quite significant. So the idea is you want to get into a property with the least amount of cash as possible, right? Use debt, right? Use it effectively and safely and have the cash flow pay for the majority of the expenses. And if you're buying in a location and a market at the right time, that's prime for growth. There's plenty of markets right now, and a very great example of areas that I'm personally buying in are across Victoria, right? In the past, I've invested in New South Wales, Queensland, Western Australia, and now more recently in Victoria. So it's important to be a borderless investor because market timing and cycles constantly change across the country, right? There are certain markets that go up, other markets that go down during that time, right? And markets will always move. That's a very normal process of the economic cycle. So as investors, we do need to try and spot opportunities of where those markets may be, and you put your money where that may have growth in the future, right? So if we do that and you go in with a low deposit, right, because you want to get into the property market as soon as possible instead of waiting for a 20%, right? Go in with a low deposit that allows you to sustain the portfolio, and then you make sure that the property that you're buying is in a good area. And the fundamentals that I only like to look at is buying in a good location. For me, I personally like to stick to the capital cities, so usually 1 to 2 hours of a capital city. For me, if it's like a satellite city, that's also okay, but I don't like to buy anything 2 hours, 3 hours, 4 hours out of a capital city because I know from the past and the history what it tells us, all the properties around a capital city all go up in the long term, right? The secondly is I look at that asset type. House, townhouse, unit, they're the sort of hierarchy you have. I generally like to buy houses first because it's freestanding. Then I look at townhouses or units, right? If I can't afford a house. I have a combination of units and houses, and I like to look at different asset classes as well. As I'm getting a bit more advanced in my property journey, my transition to wealth creation has been evolving over time. So when I started, because I had a very limited deposit and borrowing capacity, I started off buying units, and then I started buying freestanding houses. And more recently, we've been looking at commercial property within our self-managed super fund. And also later on, the next step for me is to buy a unit block as well, where it consists of multiple properties within the same unit on one title, right, to have multiple income sources. Because right now, we've built up the asset base. We do want to continue building the asset base, but for me now, it's more transitioning into the income phase, right? And for me to get into that income phase, I do need to generate a higher yield and higher net yield. That's my framework, is to look at aggressively accumulation in the beginning. That accumulation will allow you to hit the asset base. And then over time, you need to be very patient on holding growth because no one has a crystal ball. No one knows which market is going to go up next. We can only buy with the fundamentals and the information and data that we have today that will suggest growth. But if you look at past performance, that will typically give you an idea of what may happen again in the future. Doesn't promise future performance, but if you look back 100 years and you look at the things that have supported property in the past, you can't really go wrong with the fundamentals, right? Good location, and if you're buying at the right price, right timing in the market, if the market hasn't moved too much in the last couple of years, usually those areas are going to be primed for growth. And a lot of the properties that I have been buying that have done really well have been in markets where they haven't grown for a long period of time. And a good example that I'll share right now is Southeast Queensland, Logan, right? A lot of those properties that I bought in 2020 had not moved for a long time, for about 5 or 6 years. So within 2 to 3 years of holding those properties, they went up significantly, right? But I also had properties in my portfolio that had done very little. I bought a property in Wynnum in 2015. That property did very little growth for about 5 to 6 years, right? Because I bought at a different time, right? But I did ride the entire growth of that market. But it took me 5 years of holding to get growth out of that property. And I've also had property that has gone up and gone down quite a lot as well, and that was my first property. So had I sold it at the right time, I actually would have been able to cash in. Unfortunately, I wasn't able to sell it for a good price, but it's through these learnings that I share with you, I approach property investing, and also how I approach when to enter and when to exit markets as well. That's what I wanted to share with you. The second part is fundamentals, location, and market timing. And then lastly, what I plan to do personally into the future for my personal portfolio is now to transition to income, right? So I've built a incredible business around me, and for me, I think it's important to also create security outside of the business, because business income, what I've learned is it can be variable, right? Unlike PAYG income as a salary is very consistent, right? You get paid the same salary every single year. Business income can be very, very lucrative. Good times don't always last forever, but bad times don't always last forever, right? So what I'm trying to do now is create a financial security outside of the business where I can transition business profits into other entities and also into other asset types as well, to create that financial security for me, right? If in case anything happens to the business. And this is what I'm going to share with you going into the future, right? Building up this portfolio, how I transition into different asset classes, right? Looking at residential, commercial property, unit blocks, for example, and share with you what I'm doing. One of the projects I'm doing right now is actually looking at doing a subdivision. This one is in Victoria, in Geelong. So I'll share with you guys a bit more detail later on. But this is the first video that I've created, and thank you for following to the end. And I hope to be sharing with you guys a lot more, and see you in the next video.